And what we can see here, and jump in any time, Bryce, let me just bring that up into a full screen. I mean, the vacancy rate story is quite incredible across all markets. So we'll quickly run through them. But we can see here Darwin, current vacancy rate of 0.67 of 1%. We look at Hobart, still quite strong at 0.85, so very tight rental markets there. Let's look at Melbourne. We can see that that is easing off at 0.92. Now, my view on the Melbourne market has been changed on rental increases based on the 20,000 less rental international students that are coming into that market, because I've got to factor in that 20,000 rental students won't be coming into our apartments in the city area. And so that's definitely, in my mind, putting a downward pressure on rents in that Melbourne market. If all of those students were allowed to come before the federal government intervened to stop those students arriving, then there would have been even further pressure on rental values in the Melbourne
I
market.
think that's been underpinned too, Ben, by the fact that there's a ton of landlords that have actually, as per the rental bond lodgements actually dropping,
Yep.
would counteract that. So less people coming in, less properties on the market. So it's kind of been able to hide that a little bit.
Yeah, good point. Good point. Canberra seeing at 1%. Then we've got Brisbane. It's coming off its record lows, but at 0.67. And then we've got Adelaide also, you can see here, 0.61, super tight market. And then you've got Sydney, which is starting to be, a cooling in that particular market. Now, all this also bodes well for inflation, guys. Remember that inflation in terms of the basket of goods, from a property point of view or a housing point of view, rental inflation, which is still running way above where the RBA needs it to be. So I think it's in the sixes still, late sixes, I think 6.9 from memory. So that along with input cost to build new homes is around 25% of the CPI basket of goods as part of the inflation story that we look at there. So that's one story. And then let's round it off with obviously the Perth story there. And we can see, I'm going to find Perth. Let me hover over Perth. There we go. Also super tight in the Perth market, where we can see it's now down to 0.63 as well. And that has resulted to the story that is, these rental increases. We can see here's the change in annual rents for houses. We can see there that Perth has been 10.8%, Adelaide 7.9, Melbourne 6.4, Sydney 6.4, Hobart 5.7, Brisbane 5.4, Canberra 3.5, and Darwin 2.2%. And those, feel very, very strong. But the surprise for me is really that Melbourne housing story. So I can make the argument for the unit market, but it's a little bit less easy to make that argument for international students moving into housing. So is that a combination of people regrouping and doing a lot more share housing to adjust for affordability as part of that story? I'm not quite sure in terms of what that particular story looks like. But then when we look at the rents for the unit market, we're also starting to see, look at Perth, 11.7, again, off a really high income story there. Adelaide, 9.3, Melbourne, 6.6, Sydney, 5.2, Brisbane, 5.1, Hobart, 3.7, Darwin, 1.8, and Canberra, 1.8 as well. So good news for inflation, but I suspect that the increase in rents will continue to keep rising above the long-term inflation level as small business private rental accommodation providers continue to, they're currently subsidising the majority of their tenants. So I suspect that inflation will still, that annual increase will still remain elevated above that 4% in my mind for a reasonable period of time, given the shortage of rental accommodation that's currently available.
But the increase in the national rental index, Ben, that increased by just 0.1% over that September quarter. So that's the smallest change over a rolling 3-month period for 4 years. I think that's probably the important thing to note here. They're all strong. They're all very good. We're about to run through the rental yields, so you can see that there's a compelling case to be able to be a residential rental provider in this country. But the momentum is starting to sort of maybe look like it's getting to the peak across the country. And I think that's reflective of the fact that they've stopped letting as many people in at the border, Ben. And so I think that's important for us to acknowledge as well.
Yeah, I know. I couldn't agree more. And I think what we've also got to remember in terms of how you calculate gross rental yields is ultimately the value of the property and then the rent that's being received. So, like, look at Darwin at a 6.8% yield. That's been because, again, capital growth has been very sluggish in that particular market. So over time, rents have been able to keep increasing because the value hasn't. But if you get strong price growth and strong rental growth, at the same time, the yields don't look like they're going anywhere, but they are still moving up in terms of the dollars that are being paid. So, you're seeing Perth here at 4.2%. So that's come off a long-term sort of 4.8. Even in some cases, you got 5% in some markets over there. So that's been a product of the 74% price growth that Bryce was talking about earlier. But you can still see, so Canberra 4.1, Darwin 6.8, Hobart 4.3, Perth 4.2, Adelaide 3.7, Brisbane 3.7, Melbourne 3.7, and Sydney 3%. And then the regions, do you want to run through the regions, Bryce?
Yeah, regional Northern Territory 7.3, regional Tas 4.4, regional WA 6%, SA 4.8, Queensland 4.5, regional Vic is 4.2, and regional New South Wales is 4.1. Hey, that yield of 3% for Sydney just kind of gives you a bit of an insight into on the ground anecdotal conversations that we're having with clients around. It's very difficult to buy into that particular market, because when you're buying in seven-figure entry prices and you've got a 3% yield compared to where you can get yields across the country, even just across the border, you're getting closer to 4% over there in Brisbane. That kind of gives you a bit of an insight into that market. Lots of owner-occupiers, even the wealthy people who have big incomes are still finding it difficult for the outer pockets that come in that particular market.
Yeah, and a quick little reminder for the rookie players in this particular space, this is a really good education moment, and that is that the gross is not what you get, it's the net that you get. So you've got to look at your holding costs. And this is why we argue Canberra is shocking, because you give all the holding costs away in land tax. But you're also starting to see, we've seen insurance premiums on property increase between 16 to say 23% in some particular markets. And now we've got insurance premiums that are factoring in climate change. So certain markets that are susceptible to major weather events of cyclones, heavy flooding, and those types of areas, you do need an extraordinary level of rental yield just to get to a net outcome, because you're basically paying in higher costs. And that's something that a small business owner needs to understand, that it's all well and good that I'm taking higher revenue in at the top, but if my holding costs and operating costs of running my small business is continuing to keep growing, that whole story of getting that passive income to the bottom line when you retire is a really important story. So we've got to make sure, and this is the reason why we're going to be talking about negative gearing and capital gains tax exemptions next week, is that let's say they do ban it. That's another 30% cost base that's going to hit our bottom line. So all of a sudden, in terms of the risk-adjusted return, is it worth us in terms of even investing in this particular marketplace? So they're the types of stories that the government need to understand, because you won't have any supply of rental accommodation if you're not going. Well, those who stay in, they're going to have an incredible situation, right, where they're going to have so much demand for their business, for their accommodation, that they will be able to continue to ratchet it up. But it ultimately will be, that's not where we want to be. We don't want to have record levels of rent. We want to have the balance right, which is a good amount of supply, a good amount of stock, and then that capital growth and that rental income coming off in an open free market operating, as opposed to a restricted or regulated market, and you get all these unintended consequences.